Kia ora, I'm Nadine Higgins and welcome to your personal finance podcast, The Prosperity Project. On this podcast, I'm on a mission to empower you financially. I am a columnist and a journalist, an investor, a financial advisor, and the mum of a toddler. But I do not claim to be the font of all knowledge. I'm still figuring it out too. And that's why I'll be bringing you the experts and mining their big brains for all the things you and I need to know every week. If you've peeked at your KiwiSaver or other investments lately, it might have given you a bit of a rude shock. With the US introducing tariffs, withdrawing them, threatening to double them, and other countries starting to retaliate, there is a lot of uncertainty out there, and that is one thing the markets really don't like. So what do you need to know, and what, if anything, should you be doing about it? To help us hopefully answer that question is Mark Riggall, a portfolio manager for Milford Asset Management. Kia ora, Mark.
Hi.
Why are the markets so nervous? Is it just about the tariff question?
Yeah, it's a great question. And there's obviously a fair amount going on. Tariffs and the noise, and like you said, whether they're on or off and what size, is certainly not helping. But if we stand back a little bit, this is a kind of market environment that's been building a little bit for the last few months. And what's really happening is that the US growth story, i.e. the economic growth in the US, is slowing a little bit. So had been going very, very strong, growing at 2.5% plus for the last couple of years, which has been fantastic. But now, for a variety of reasons, looks to be slowing a bit. And slowing a bit means, maybe it's going to grow at 1%. 1.5%, which is fine. But when investors had been expecting that 2.5% growth to keep going, and certainly expecting the Trump administration to be more pro-business and pro the stock market, to have them come out and start announcing all these tariffs and increasing the uncertainty certainly has upended things, and investors are changing their mind in terms of where they're investing and have been selling US shares as a result.
How much of a fall have we seen across US markets?
So US markets, which are clearly the biggest markets in the world, they've fallen around 10% from their peak. Some stocks have clearly fallen further. The technology stocks have fallen a little bit further. But it's not all bad news. And there are other parts of the world that are not faring so badly. So Europe has been doing quite well this year and in fact is up on the year. So it's a big contrast to what's going on in the US.
10% though, when things had been going so well, is probably enough to spook a lot of people. Have you guys been fielding calls from investors or KiwiSavers saying, what should I do?
Yeah, for sure. I mean, people, I think in the last 2 years, when we've just seen markets or share markets just rallying fairly consistently over a 2-year period, perhaps lulled people into a bit of a sense of security that this was the norm. In fact, a little bit of volatility now and again is pretty usual for share markets, and a 10% fall, while it's enough to get people concerned, is not really something that is too concerning for people that have kind of been involved in markets for many years, but certainly has people's attention up. But it's so far nothing too concerning.
But for those who don't do this day in, day out like you do and have seen the ups and downs over the market cycles, it can be a bit scary. What should they be doing, or should they be doing nothing? The usual advice is just sit tight, but that's hard to do when you're stressing out.
Yeah, that's right. And so if you're investing, or if you're in KiwiSaver, or if you have other financial market investments, then as always, you should be checking that those investments are commensurate with your goals, your investment time frame. So if it's KiwiSaver, by definition, that's a retirement product, and for many people, that kind of the use for those funds is going to be many, many years away. And so doing something in the short term because you're concerned about what's going on, might be detrimental actually to your long-term returns. So I think for KiwiSaver, it's, as long as your circumstances haven't changed, then really there's not much to do. Of course, pay attention, make sure you know what your fund manager's doing and how they're positioned. But by and large for KiwiSaver, it should be really easy just to stay pat.
Just to make it abundantly clear, what are the risks if you do freak out and go, okay, I don't want to be in a growth fund or an aggressive fund. I actually want to be in a conservative fund. What could be the impact of doing that at a time like this?
Yeah, so, Generally speaking, and this is of course generally speaking, growth funds tend to outperform conservative funds over the long run. And the reason they outperform is because they take more risk, right? They invest more into shares, which are riskier investments. The reason they're riskier is because they tend to have more volatility, and that's the volatility that we're seeing right now. So if you freak out right now and reduce or go from a growth fund to a conservative fund, for example, the chances are that over the long run, and we're talking many years, you could be impacting your kind of retirement nest egg because you've reduced your exposure to growth or risky assets at a time when everyone else is trying to do the same thing, and that's not normally the best time to do that. So there are risks to changing your investments at times like this, yes.
And I guess it also means if you sell after the markets have fallen 10%, then you are taking a paper loss to an actual loss.
Correct. Yes. I mean, obviously, investing involves risk and reward. You can't get the reward without the risk, and this is the risk. And so, kind of weathering these bouts of volatility comes part and parcel with holding riskier investments, and crystallizing them, like you say, after a fall is can be detrimental to long-term returns.
For argument's sake, if you're not necessarily investing for retirement, you're just investing, would you be looking at your strategy right now and going, oh, okay, tech shares are down, Europe's looking a bit better, should I change my asset mix?
That's a great question, and as it's almost it's going to depend on each individual's kind of objectives in terms of how they're investing. What I can say is for investment managers like ourselves who are very active in kind of looking for opportunities, the current environment is one that does offer up lots and lots of different opportunities. Whereas the last 2 years have been invest in technology stocks and nothing else. Now we're getting a chance to go and invest in Europe. And drive some returns and find some good companies there at reasonable valuations. And so it's a change in the status quo. And when there's a change in the status quo, that tends to offer up more and more opportunity. So that's quite exciting. I'm not going to start promoting any different investments. This is not advice, but certainly, for people who are active investors, it can be quite an exciting time.
You've mentioned tech stocks, and I guess, Tesla's down. I don't know whether that's specifically just because of Tesla and Elon Musk's association with the Trump administration, or is it that tech stocks in general are coming off the boil?
It's part and parcel of a couple of trends that we've seen build over the last couple of years. So obviously, tech stocks have done very well broadly, and that's included names like Tesla, and then more recently they have struggled. So why have they struggled? I think because investors were heavily exposed to those types of companies. If you look at the weight of these companies in global share markets, they've got very, very large, and so some rebalancing would mean you would by definition have to sell some of these larger companies to buy other things. So it's kind of no surprise that rebalancing is causing underperformance of these companies. The second thing is the last 2 years has seen a huge resurgence in what's been called the retail investor, where the access to financial markets has become incredibly easy via apps and different platforms, and names like Tesla have become quite popular. And so, when markets tend to turn, these names get hit, normally harder because, lots of different types of investors are all selling at the same time.
So the retail investors are buying based on like name recognition or brand recognition, and then they get spooked and sell?
Yeah, that's right. So there's a lot of name recognition. Obviously, Tesla's very high profile. There's a lot of momentum that goes involved with retail investing. So stocks that have done well tend to be invested in and can continue that momentum. That momentum works in both directions. So that works very well when stocks are going up, and then obviously when things reverse, it can kind of hurt on the downside as well. So those trends can persist for reasonable lengths of time, but of course, markets can be volatile and go up and down. So it's not worth staying with one trend for forever.
The other conventional piece of wisdom that is dispensed at times like this is buy the dip. Markets are down. Buy. Is there also some sense in that?
Uh, there is, and you can think about it. Rather than saying buy the dip, you can think about dollar cost averaging. So for a retirement product like KiwiSaver, where you're contributing every month from your salary, that is averaging in, right? You are buying more units of whichever fund you're in, and if markets are volatile, and we've seen price falls in the recent history, then you're buying more units for the same dollars that you're investing, and then over the long run, when you should see price appreciation of these funds, then that should benefit you. So dollar cost averaging and kind of continuing to buy the same amount of money throughout can help, and these bits of volatility help you with that long term kind of wealth appreciation. As for buying the tip, it's been a strategy that's worked very, very well over the last 10 years or even more. As to when the dip is over is another question. The dip could be over now, or it could be over another 10% lower. Who knows really. So that's the kind of difficult question if you're trying to buy the dip.
While KiwiSaver is primarily a retirement investment vehicle, for many people it's also then their part of their deposit for their first home. They need quite a different strategy at a time like this, right? If they're looking at buying next week, next month, next year, in the next few years even, that's a different time frame, isn't it?
Yeah, that's right. So if your time frame is shorter because you think you need those funds not at retirement, but like you say, for buying a home in the next few years, then that does change your risk appetite, because risky assets are volatile. That means in the short run, you may risk losing some money, even if in the long run, over 10, 15, 20 years, you're better off in that strategy. So it does change your risk appetite. And so people who are thinking they might need the money sooner should be in lower risk products, as a result of that different time horizon.
We're just going to take a quick break, and we will be back with Mark very shortly to talk about the R word, recession. See you shortly. Welcome back to the Prosperity Project. We're talking to Mark Riggall from Milford Asset Management about the current market uncertainty. And I guess one of the things that has rattled people is Trump being asked the question about, are we headed for a recession in the US? And he didn't rule it out. Do you foresee one?
It's very hard to predict a recession. Many people try, and oftentimes recessions only get called and made official many months after
in
the
hindsight,
fact.
Yeah.
Right. So trying to predict one coming down the track is quite difficult. So what I can say is, where are the ingredients? What's going to cause the US economy to fall into a recession? You typically need some degree of overinvestment in some part of the economy. And if we look at the private sector in the US, i.e. households and businesses, what do their balance sheets look like? Are households stretched at the moment? Are they kind of over indebted, or are corporates over indebted? And the answer to both those questions are that in aggregate, actually, households and corporates in the US are in good shape. So that's good news, because it means there's underlying strength in the US economy, and it can weather storms that come along, including the storm that we're currently experiencing in terms of the Trump administration. So whilst, like I said at the outset, the US economy is growing a little bit slower than it has done previously, and by definition, if an economy is running slower, then it's closer to that zero bound or recessionary level. So by definition, the chance of a recession happening, it does increase. But we think that the US economy is in reasonable shape, and so whilst it might be growing slower, we think it's unlikely that they can talk themselves into recession by Trump being negative or creating so much uncertainty.
What about, though, if there are big tariffs being placed on our big trading partners outside the US, like Australia and China? Does that have an impact to hurt our economy, even if they don't tariff our exports directly?
Yeah, so tariffs are, they are a tax. Effectively, you can argue who pays that tax, but they are a tax, and as such, they're a brake on growth. So tariffs, if they get enacted, and certainly there's some big numbers being talked about, if they get enacted for a significant period of time, then that can be a constraint on global growth, not just the US. And so we have to bear that in mind, and we have to, consider that eventuality. I think it's unlikely that any policymaker, including Trump, is willing to tax their own economy into recession. That's something politicians don't tend to like doing. And so I would, wager that the tariffs are, a tool rather than, a kind of something that will kind of be a feature of global trade for, the long term.
Do you think that we're just in for this sort of uncertainty and volatility for the next 4 years, or do you foresee things settling down?
I guess we've already had this once. The last time Trump was in power, and certainly, the level of volatility does increase, and markets are likely to be choppier as a result. Choppier doesn't mean necessarily negative. It means that we could have swings up and down, and we could have more rotations going on in terms of which types of companies, which regions do well or otherwise. So I would expect that there's more volatility going forward. For us, that means more opportunities, which is, a good thing. But I think if we think about his strategy and what he appears to be trying to do, he tries to be front loading a lot of the pain into the beginning of his term, and then hopefully delivering some more kind of easier policies that would help the economy and markets kind of in the second part of his administration. So maybe the volatility we're seeing now isn't going to be persistent for the whole 4 years, or at least we hope so.
We certainly do. There might be opportunity, but it's a little unsettling when you're watching your KiwiSaver or your other investments take a hammering. We are focusing a lot, though, on the share market, the S&P 500 and those falling. What is the bond market doing? I feel like that gets less focus and it's less well understood, but it does have implications for borrowing costs.
Yeah, it's got implications for borrowing costs, and then these are the costs obviously set by the central banks and by the market, and it's got implications for investors as well. So, for diversified funds like KiwiSaver funds, like conservative funds, their predominant investments are actually bonds rather than shares. So it does get less press and less attention than its cousin, the share market, but the bond market is really important. And so what we've seen is that the bond market has had a tough time in the last 4 years or so, because we went from a period when interest rates were very low to a period when interest rates were higher, and the bond market needed to adjust, so bond prices fell. We've had that, so that pain's behind us. And what do we think going forward? Well, now bonds are offering a reasonable return, a reasonable yield, where you can own those bonds and get paid those interest rates, get paid those coupons for the next few years, and that can help cushion portfolios. So you're earning those yields even if your share portion of your portfolio is going up and down. So it does cushion portfolios in a way that hadn't had that luxury for the last 5 or 10 years. So that's a good thing. The second question is, well, what happens if we do get a global growth slowdown or even recession in some parts of the world? So this is not a base case, but there's a risk that it could happen. And bonds in that situation could actually provide a very good investment, because they'll likely go up in price. Because when we get a recession or a growth slowdown, central banks will cut interest rates. And when interest rates fall, bond prices go up. So they can prove to be really good parts of a diversified fund, so that they can cushion that volatility you get on the shares.
So is it still a case, Mark, of when the US sneezes, the whole world catches a cold? Or do we rely less on them leading the way now, or more?
So the US is clearly a huge part of the global economy. And so if the US is weaker, then yes, all else equal, the globe is going to struggle. However, there are offsetting factors. And so what we're seeing in recent weeks is the German government in Europe has announced a fiscal package, which is enormous. They're trying to ratify that through their parliament right now. But it is likely that they'll do something on that. So the Germans have been effectively handcuffing themselves in terms of government spending, and now they're taking those handcuffs off. That's also going on in other parts of Europe where they're increasing spending on defence. You can argue rightly or wrongly whether that's a good thing or not. But what we can say is that its implications for growth are positive. So any spending by the government, any investment or on kind of defence or otherwise is going to be a positive boost for growth. We're also seeing a little bit of stimulus coming out of China. It's not particularly sizable, but they are trying to stimulate their economy. They're trying to stimulate their own consumer so that they can improve things domestically in China. So while the US's growth prospects are kind of slightly weaker right now, other parts of the world are improving. So it's not all bad news.
What is the one thing that you would encourage investors, be they KiwiSaver, managed fund or retail, direct investors in particular shares? What's the one thing that you would encourage them to keep in mind at the moment?
I guess, having, and even if you look back over the last 4 or 5 years, we dealt with COVID and all of that. We've had the first Trump administration with the volatility there. We had the GFC before that. The crises come and go. This too shall pass. And the long term is what investors should be focused on. If there are concerns, and there always can be concerns, then just reach out, seek advice, speak to a financial advisor, and get comfort in how you're invested for the long run.
I guess it's at times like this you find out whether your risk appetite is really what you thought it was, right?
Yes, that's true.
This too shall pass is a good motto. Thank you so much for your time, Mark Riggall from Milford Asset Management.
Thank you. Great to talk to you today.
Thanks for listening to The Prosperity Project. You can follow this podcast on iHeartRadio or wherever you get your podcasts, and please do chuck us a rating or a review while you're there. For more personal finance and business content, head to nzherald.co.nz, and please do feel free to get in touch with your questions and your stories. nadine.higgins at nzme.co.nz. A reminder, though, that this podcast is informational only and nothing we say here should be considered personalised financial advice. But also remember that while listening to this podcast is hopefully going to be additive to your financial knowledge, and that is fantastic, knowing stuff doesn't create change. Doing stuff does. So what action are you going to take today to make your life more prosperous? My producer for this episode is Ethan Sills. Sound engineer is Richard Martin. I'm Nadine Higgins. Thanks for listening to The Prosperity Project.